Risk Budgeting Views, May 2012. Hi there and welcome to our short audio stories on aspects, issues, matters and concepts in the risk management field. My name is Dimitri, an associate here at Systemic Risk Management, writing, reporting and presenting mostly from a practical standpoint on the subject of better risk control for portfolio management professionals and others interested in these matters. Today's shorty will be on risk budgeting. Risk budgeting is like capital budgeting. With risk budgeting, portfolio weights are based on security risk contribution. With capital budgeting, portfolio weights are based on security return contribution. Active management is mostly returns-based. Passive management, weights are according to the benchmark index, and with asset class investment, it can be mostly risk-based. We have the equal weight, or 1/n, portfolio, which is basically a heuristic approach without regard to risk attributes, and it does not take into account volatilities and correlations data. We also have the minimum variance portfolio, which does not take into account returns information and suffers from overexposure to securities with very low volatilities. Then we have the equal risk contribution portfolio, where the weights are according to a marginal risk contribution, and it's somewhere between the 1/n and minimum variance weights. Then we have the maximum diversification portfolio, which it has weights based mostly on low correlations, and this portfolio is closer to the 1/n portfolio, or the equal weight. Finally, we have the minimum variance optimum portfolio, which is the only theoretically derived global optimum portfolio, where the weights are based on statistical analysis of risk and return data. With concepts in risk budgeting, we have marginal VaR for infinitesimal weight changes, where the partial derivative with respect to the component weight measures the change in portfolio VaR resulting from an additional numerical component. We also have a component VaR for dropping a stock in a portfolio, a partition of the portfolio VaR that indicates a change of VaR if a given component security was deleted from the current portfolio. And we also have the concept of incremental VaR for adding a stock in a portfolio, which measures a change in VaR due to a new position in the portfolio. We also have relative VaR, which is relative to a benchmark, which is not exactly the same as tracking error, and is constrained to 2 times VaR by some regulators. And then we have multi-factor risk models, which are based on size, value, momentum, liquidity, volatilities, skewness, kurtosis, correlations, and dispersions. When we have rebalanced it, we can have it discrete or continuous. If we have it continuous, it will be dynamic for cost risk control. When it's discrete, it will be periodic, threshold-based, or fixed interval. And then we have the concept of restructuring, which is strategic in focus beyond rebalancing, where we have risk shifting or major changes in asset allocation. And obviously, it has a policy impact because it results in a new strategic asset allocation. And then finally, when we talk about active risk control, do nothing or trading paradise, all these things can be quite important because of the returns and costs involved in dynamically having your portfolio risk properly risk controlled all the time.